Before you begin your student loan repayment journey, you'll need to know all the basics. First, it's important to know the key terms frequently used when talking about federal student loans. This includes principal, interest, and total loan balance. Your principal balance is the original balance of the loans you borrowed for school. Interest is additional money charged daily on your principal balance. Loans have unique interest rates based on loan type and when the loan was taken out. These interest rates are fixed for the life of your loan and will never change. Your interest rate is multiplied by your principal balance to get a yearly interest amount. And if you divide this amount by 365, you get your daily interest amount for your principal balance. When you receive a billing statement from your loan servicer, you'll see a total balance. This total balance is the sum of your principal amount due and the interest that's been added. You'll also find a monthly payment amount that's due. This amount is dependent on which repayment plan you're enrolled in. Second, it's important to know which loans you have, because they determine which repayment plans you qualify for. There are 5 main federal loan types: direct subsidized loans, direct unsubsidized loans, direct consolidation loans, direct plus loans for parents, and direct plus loans for graduate or professional students. Direct subsidized loans are loans with an interest subsidy, which means that interest is covered by the government while you're in school and during your 6-month grace period. Once you get to the repayment stage, the total balance is the amount you originally borrowed. Direct unsubsidized loans don't have this interest subsidy, so interest starts accruing immediately and continues accumulating for the life of the loan. A direct consolidation loan is created when you combine multiple federal student loans. When you consolidate your loans, the interest rate of the new consolidation loan will be a weighted average of the interest rates of the loans consolidated to create it. Loan consolidation is not always recommended, but there are specific situations when a direct consolidation loan can be beneficial. Learn more about loan consolidation by visiting studentaid.gov/consolidation. Direct plus loans for parents are unsubsidized loans offered to parents of undergraduate students. These loans are the responsibility of the parent and cannot be transferred to their child. Direct plus loans for graduate or professional students are unsubsidized loans for students enrolled at least half-time at an eligible school in a program leading to a graduate or professional degree or certificate. Once you know what loans you have, you can figure out when you'll be entering repayment. If you have direct subsidized or unsubsidized loans, you'll enter repayment after your 6-month grace period, which ends 6 months after graduating, leaving school, or dropping below half-time enrollment. If you have Parent Plus loans, loan repayment begins once your loan has been fully disbursed. However, you can request a deferment while your child remains enrolled at least half-time and for 6 months after they graduate, leave school, or drop below half-time. Parent Plus loans do not receive an automatic grace period. If you're a graduate or professional student earning an advanced degree or certificate, and you have a Direct Plus loan, you'll automatically receive a 6-month deferment after graduating, leaving school, or dropping below half-time. Now you might be wondering, who is involved in your federal student loan repayment process? The U.S. Department of Education is the lender of your federal loans. That's us. We work closely with your loan servicer. Your loan servicer works on behalf of the government to help with your student loan payments, repayment plan applications, and any questions you have about your loans. To find contact information for your loan servicer, visit studentaid.gov/servicer. And remember, you never need to pay for help with your federal student loans. Now that you know who your loan servicer is and what they do, you can keep an eye out for any communications from them. As you approach your first payment due date, your loan servicer will send a billing statement that includes your payment amount due and the date that it's due. You can visit your servicer's website to pay your bill, check your total loan balance, and see your payment history. This is also where you can set up autopay for your payments to be automatically withdrawn from your bank account each month. Looking to save some money while paying off your loans? Consider the following repayment strategies. One of the best ways to spend less money over time is to make extra payments to lower the amount of interest you pay over your repayment period. If you apply for an income-driven repayment plan, you could spend less on your monthly payments, depending on your income and family size. All income-driven repayment plans lead to loan forgiveness, so after you've made qualifying payments for the duration of your repayment term, any remaining balance is forgiven. Your type of employment could also offer a path to forgiveness. For instance, if you work in public service, you could be eligible for the Public Service Loan Forgiveness or PSLF program. And if you're a teacher, you could qualify for teacher loan forgiveness. Now that you've learned the basics of federal student loan repayment, you're ready to figure out which repayment plan works for your loans and your repayment goals. Watch Your Guide to Student Loan Repayment Plans to get an overview of the different types of repayment plans offered by the federal government. If you have any questions, visit studentaid.gov/help-center or reach out to your loan servicer.